Hey everyone, welcome back to Corporate Dakota. Today, Medpace Holdings MEDP just filed their quarterly report for the 30th of June 2026, and I'm seeing some interesting growth trends. Quick note, this is not financial advice, just my take on public filings for educational purposes. In short, Medpace is growing fast, but their costs are growing even faster. Let's dive in. This is Medpace Holdings Incorporated's quarterly report. Think of it as a progress update from the company for shareholders and the public. They are a global company that helps drug and medical device companies run their clinical trials. Basically, they help get new medicines and medical devices tested and approved. Let's start by looking at what the company owns and owes. This is called the balance sheet. As of the 30th of June 2026, Medpace had over $500 million in cash and cash equivalents. This is a healthy amount showing they have money readily available. They also have a lot of accounts receivable, which means money owed to them by their customers. This is nearly $442 million. This is a good sign that they are doing business and customers owe them money. The fact that some of this is with related parties, meaning people or companies connected to Medpace, is something to keep an eye on, but the amounts are not huge compared to the total. Adding everything up, their total assets are over $2 billion. That is their total ownership in the company. Now let's look at what they owe. Their liabilities, they have about $37 million in accounts payable, which is what they owe to their suppliers. Interestingly, they have a huge amount in advance billings, over $900 million. This signifies money they have received from customers for services not yet performed. This is a strong indicator of future revenue and customer commitment. Again, a small portion is with related parties. Their total liabilities, or what they owe, are about $1.6 billion. This leaves them with total shareholders' equity of about $433 million. This is what is left for the owners after all debts are paid. Now let's look at how they have been performing financially. The statement of operations. This tells us about their revenue and expenses. For the 3 months ending the 30th of June 2026, their revenue was over $707 million. That is a big jump, a 17.2% increase compared to the same period in the previous year. For the first 6 months of 2026, their revenue reached over $1.4 billion, up 21.7% from the prior year. This shows really strong growth. However, their costs are also growing. Reimbursed out of pocket expenses, which are costs they pay for on behalf of their clients, jumped significantly for the 3-month period. They were up 27.7%, and for the 6-month period, they shot up by almost 40%. This means their total operating expenses grew by 17.5% for the quarter and 22.1% for the half year. Even with rising costs, their income from operations still grew to over $146 million for the quarter and almost $288 million for the 6 months. This is good, showing they are managing to make money despite the increased expenses. Ultimately, their net income, or the profit left after all expenses and taxes, was $121 million for the quarter and over $245 million for the 6 months. This is a solid increase from the previous year. What this means for the average shareholder is that their earnings per S-share, or EPs, is $4.31 for the quarter, up from $3.16 last year. This is a very positive sign for investors. Now, the number of shares outstanding is actually decreased a bit, which is often a good thing for shareholders, as it means each share represents a slightly larger piece of the company. Let's look at how Medpace is managing its cash. This is the statement of cash flows. For the first 6 months of 2026, their operating activities generated over $313 million in cash. This is up from about $274 million in the same period last year. This shows they are bringing in more cash from their core business operations. However, their investing activities, which include buying property and equipment, used up over $30 million. This is likely for expanding their facilities and equipment to handle their growth. On the financing side, this is where things get really interesting. They spent nearly $295 million in the first half of 2026 buying back their own stock. This is a huge amount, and it is even more significant when you look at the previous year, where they spent over $912 million on buybacks in the same period. It looks like they are still committed to returning capital to shareholders through buybacks, though at a slightly reduced pace compared to the very aggressive pace of 2025. The company approved a share repurchase program and has been actively buying back shares. In the second quarter of 2026 alone, they repurchased over 700,000 shares for about $295 million. This is a significant amount of money, indicating strong confidence in their own stock. They still have over $500 million left on their authorization for future buybacks. Now, let's touch on related party transactions. These are business dealings between the company and its executives or affiliated entities. Medpace has service agreements with entities like Lib Therapeutics and Synerx Pharma, where company executives are also involved. They recognize revenue from these related parties. And it is important to see that these amounts, while present, are not overwhelmingly large compared to their total revenue. For example, revenue from Synerx was about $3.5 million for the quarter. They also have leases for office space with entities wholly owned by their chief executive officer. These lease costs are significant but disclosed and seem to be at market rates. It is important that these transactions are clearly disclosed and managed appropriately to avoid any conflicts of interest. Medpace appears to operate in a single reportable segment. Looking at their revenue by therapeutic area, we see that oncology and metabolic diseases are their largest contributors. Metabolic revenue grew significantly in the first half of 2026, up from previous periods. Oncology revenue also saw a strong increase. These areas represent key growth drivers for the company. This section essentially gives management's perspective on the results. They highlight strong revenue growth driven by their key therapeutic areas. They also mention increased costs, particularly in reimbursed out, of pocket expenses and personnel costs needed to support growth. Like most big companies, they include forward-looking statements. These are basically their best guesses about the future based on current trends. They warn that actual results could be different due to risks and uncertainties. It is important to remember that these are just projections. Going back to the cash flows, the operating cash flow is generally strong. For the 6 months ended the 30th of June 2026, it was over $313 million, showing good cash generation from their core business. The heavy spending on share buybacks in financing activities, over $294 million in the second quarter of 2026, is a key theme. This reduces the number of shares outstanding and theoretically increases the value of the remaining shares. They have ample liquidity with over $500 million in cash and cash equivalents. They see their cash flow from operations and their $10 million credit facility as sufficient for their needs, which include investments in growth, capital expenditures, and more share repurchases. Overall, Medpace is showing impressive revenue growth, particularly in key therapeutic areas like oncology and metabolic diseases. Their net income and earnings per S-share are up, which is great for shareholders. They are also returning a significant amount of capital to shareholders through share buybacks. However, it is crucial to note that their costs, especially those reimbursed out, of pocket expenses and personnel costs supporting growth are also increasing substantially. This trend of costs growing alongside revenue is something to monitor closely. They have a healthy cash position and strong operating cash flow to support their initiatives, including continued investment in expansion and buybacks. The related party transactions are disclosed and seem manageable within the overall financial picture. The risk I am watching is whether they can keep their cost growth in check as revenue continues to climb. My biggest concern is that if these reimbursed out of pocket expenses continue to outpace revenue growth, it could eventually impact profitability. What I'm actually looking for is a sustained trend of revenue growth that outpaces cost increases. The research tools I use are linked in the description below. They help tremendously with these filings. That is my take. Stay decoded, like, comment, and subscribe to catch all our future filings analysis. Find our Discord in the description.